Welcome to Tech Money Madness, your daily U.S. stock market podcast, July 29, 2026.
Glad to be here for this one.
Yeah, we've got a massive deep dive for you today. Look, if you're checking your portfolio right now, you're probably seeing the major indices, the Dow Jones, the S&P 500, the NASDAQ, just completely locked in this tense tug of war.
Oh, absolutely. It's pulling the market apart at the seams today.
Right, because we have a 120-year-old car company declaring war on Elon Musk, Apple basically deciding to stop selling you phones, and NVIDIA maneuvering to just, swallow the entire architecture of the internet.
Yeah, it's the perfect storm. You have traders trying to price in two completely conflicting realities at the exact same time. On one side, you have overseas central banks basically panicking about inflation and slamming on the brakes.
Hitting the brakes hard.
Exactly. But then on the other side, domestic economic data here in the U.S. is starting to look, well, decidedly sluggish.
Yeah, sluggish is putting it mildly.
Right. And you throw in a tech sector that is aggressively trying to justify these historically massive valuations through cutthroat competition. You get the kind of volatility we are seeing on the board today. Capital is desperately searching for certainty.
It really is. And, to understand how those indices are physically moving today, we really have to follow the money supply.
Always follow the money.
Always. And the foundational economic data driving that capital flow today actually starts overseas. With a massive surprise out of Asia.
Yeah, Singapore.
Right. The Monetary Authority of Singapore, the MAS, they suddenly moved to tighten their monetary policy. And they cited rising oil prices as the primary driver for these renewed inflation fears.
Which sent a very specific shockwave through institutional trading desks this morning.
Oh, I bet.
Because the MAS acting hawkish simply means they are prioritizing killing inflation over growing their economy, usually by making money more expensive to borrow.
So they're actively trying to destroy demand.
Precisely. They want to make it harder for businesses to get loans for expansion, harder for consumers to finance purchases, which, theoretically brings prices down.
But for someone listening to this deep dive, looking at a U.S. stock portfolio, why does Singapore's move matter so much?
Because Singapore is a massive global trade hub. They don't act in a vacuum. Their anxiety reflects a broader fear among global central banks that the inflation dragon is not entirely dead, mostly because energy prices are just stubbornly refusing to cooperate.
But let's look at the contradiction here because it's wild. Think of global capital like a massive interconnected highway system.
Okay, I like that.
You have Singapore slamming on the brakes, causing a traffic jam for international capital. But then you look at the lane containing the U.S. economy, and the data shows we're already coasting to a halt on our own.
We really are.
The latest U.S. jobs report came out, and it was a dramatic miss. We only added 57,000 non-farm payrolls.
Which is shockingly low.
Right, it's just the standard measure of job creation that excludes agricultural workers, but adding only 57,000 jobs. That pushed the unemployment rate up to 4.2%.
And that 4.2% is the number the bond market is obsessing over today.
Why that number specifically?
Well, the U.S. consumer has been the indestructible engine of the global economy for the last 3 years. But an unemployment rate creeping up to 4.2 tells us the engine is starting to sputter. Employers are pulling back on hiring.
Right.
But the crucial piece of the puzzle here is what happened to the pricing data alongside those job numbers.
Yeah, the inflation data. So consumer prices in the U.S. rose by 3.5% annually, which actually came in lower than expected.
A nice surprise.
Yeah. But more importantly, wholesale prices. The actual costs that businesses pay to manufacture and ship goods, those unexpectedly dropped by 0.3%.
Huge drop.
Right. And it was primarily driven by falling gas prices here at home. Because if it costs a business less to make a product, eventually it costs you less at the register. So, keeping with the highway traffic jam analogy, we've got Singapore hitting the brakes, fighting an inflation heat wave, while the U.S. consumer is basically feeling a cooling breeze in the labor market.
It's totally contradictory weather patterns.
Right. So what does the Federal Reserve do here? They have an interest rate decision looming, and they are looking at completely conflicting signals.
Well, the Federal Reserve is looking at this slowdown to 57,000 new jobs and the dropping wholesale prices, and they're seeing the exact scenario they've spent 2 years trying to engineer.
A soft landing.
Right. They want to cool the economy just enough to starve inflation of its fuel, but not so much that they throw the country into a devastating recession.
Which is a nearly impossible tightrope walk.
It really is. But this domestic cooling data provides the Fed with the political and economic cover they need.
Because of the wholesale prices dropping.
Yes, even if global peers like Singapore stay hawkish. The dropping wholesale prices signal that domestic inflationary pressure at the producer level is evaporating.
Ah, got it.
That gives the Fed room to finally consider easing interest rates, making borrowing slightly cheaper to prevent that 4.2% unemployment rate from spiraling into 5 or 6%.
Okay, so in an environment where the macro picture is that murky, where interest rates are a question mark and consumer spending is slowing down, institutional money gets terrified of risk.
Absolutely terrified.
Capital concentrates where growth is an absolute mathematical certainty. And right now, that means the money is flooding directly into AI data center infrastructure, the hardware heavyweights.
The only game in town for guaranteed growth.
Which brings us to NVIDIA, sitting at the top of the market gainers today. I mean, the numbers are insane. They just posted 140% year-over-year earnings growth.
It's massive.
And they command an 86% market share in the AI data center GPU market.
The numbers are historic, no doubt. The real story driving their stock today isn't just the earnings, it's their aggressive strategic pivot.
The CPUs.
Right. Historically, NVIDIA made the GPUs the graphics processing units. Think of the GPU as the brute force calculator that actually does the heavy lifting to train an artificial intelligence model.
Okay.
But they had to rely on other companies' CPUs, the central processing units, to act as the general manager, assigning tasks and routing data across the server.
But now NVIDIA just announced a massive expansion into manufacturing those CPUs themselves.
Exactly.
Let's break down the technical mechanics of that for a second. Because why would a company dominating one highly profitable component want to take on the massive cost of building another? Like, is it just about capturing more revenue per server?
It's actually about eliminating the physical bottleneck in the data center.
How so?
Well, a brute force calculator is useless if the general manager handing it the math problems is too slow. Historically, the speed limit of an AI supercomputer was dictated by how fast the CPU could talk to the GPU.
Oh, I see.
By designing and manufacturing both, NVIDIA controls the exact architecture of how those two chips communicate. They optimize the connection.
So they're telling their enterprise customers, basically, don't try to stitch together a Frankenstein server with parts from different companies.
Right. Buy a fully integrated NVIDIA ecosystem and you will get unprecedented speed.
I have to challenge the long-term viability of this strategy, though. Because if a company already controls 86% of the market, and they're posting 140% growth, gravity has to take over eventually, right?
You would think so.
I mean, there's a physical limit to the number of data centers the power grid can even support.
Yeah.
So is this CPU integration really an offensive strategy to conquer a new market, or is this actually a defensive moat?
That's the million-dollar question.
Are they just digging a competitive trench around their castle because they know the era of hypergrowth in GPUs is mathematically ending?
The market is absolutely pricing this in as a defensive moat. NVIDIA is hyper-aware that their 86% market share has a massive target on its back.
Right. Everyone wants a piece of that.
Every tech giant on Earth is trying to figure out how to design their own chips to avoid paying NVIDIA's premiums. By integrating the CPU, NVIDIA creates a deeply sticky ecosystem.
I mean, once you're in, you can't leave.
Exactly. Once a massive enterprise company builds their infrastructure entirely on proprietary NVIDIA architecture, the switching costs to move to a competitor become financially catastrophic. It locks the customer in for a decade.
Wow.
But you brought up the physical limitations of these data centers earlier, which actually shifts the battleground from the processors to the rest of the supply chain.
Which perfectly maps to our other top gainer today, Micron technology. And the specific catalyst for Micron's stock surge this morning is incredibly revealing.
It really is.
Elon Musk took to social media to publicly thank Micron for providing memory chips on what he called reasonable terms.
Which is such a specific thing to post about.
Right. On its face, it sounds like a billionaire just tweeting about a vendor.
But in the context of a supply chain war, it is a massive signal to institutional investors.
Because of the memory bottleneck.
Yes. If NVIDIA is building the ultimate artificial brain, a brain is completely useless without a short-term memory to hold the thoughts it's currently processing.
Makes sense.
AI models have to store astronomical amounts of data locally while they run calculations. Micron builds the high-bandwidth memory chips that physically sit next to GPUs to handle that storage.
And there's a shortage of those, right?
A severe bottleneck in high-bandwidth memory production across the entire industry. So when Elon Musk, who is currently attempting to build some of the largest AI supercomputers on the planet, publicly highlights Micron for their pricing and availability,
It validates them.
it completely validates Micron as the critical linchpin in the AI arms race. It proves they have massive pricing power and, more importantly, reliable execution.
Okay, so we're talking about billions in capital expenditures, CapEx flowing into data centers, GPUs, and memory chips.
Hundreds of billions, yeah.
But there is a fundamental law of corporate finance.
Mm-hmm.
Eventually, enterprise spending has to be justified by consumer revenue.
Absolutely. The bill comes due.
The tech industry has to actually sell a product or service to everyday people to pay for these supercomputers. And as we established earlier, the U.S. consumer is facing a 4.2% unemployment rate and a cooling labor market. The everyday buyer is tightening their belt.
Right. And the most advanced data center in the world becomes a depreciating liability if the end consumer refuses to pay $20 a month for the AI software it powers.
Or they just can't afford the device required to access it in the first place.
Exactly. Tech giants are scrambling right now to adjust their revenue models to survive a consumer slowdown.
And no company is pivoting harder today than Apple. They are surging in the market based on the announcement of a sweeping brand new leasing program for their hardware.
This is a huge shift.
Massive. You no longer buy an iPhone, you lease it directly from Apple.
And the underlying financial mechanics of this move are designed to completely alter how Wall Street values Apple's revenue. Well, when the economy cools, a $1,500 smartphone transforms from an annual necessity into a luxury item. Consumers will simply hold on to their iPhone 14 or 15 for an extra 2 years to save money.
Right, the upgrade cycle slows way down.
And that deceleration in the upgrade cycle is an existential threat to Apple's top-line revenue. By shifting the hardware to a lease, they change the consumer psychology from a massive capital expense to a manageable operating expense.
Wall Street notoriously obsesses over ARR, annual recurring revenue.
They love it.
The market will always assign a much higher stock multiple to a software company that charges you $50 a month forever than a hardware company that charges you $1,000 once every 4 years.
Every single time.
It seems like Apple is trying to turn a physical piece of glass and metal into a recurring utility bill. But does this financial engineering actually make Apple recession-proof if the unemployment rate keeps climbing?
I mean, a true recession spares almost no one, but this definitely builds a formidable financial fortress around Apple's cash flow.
Because it's predictable.
Predictable, and it smooths out their revenue, eliminating the massive peaks and valleys of holiday hardware cycles. Furthermore, it mathematically incentivizes the consumer to opt for higher margin, premium devices.
Oh, because the monthly difference is so small.
Exactly. If the absolute top-tier Pro Max model is only an extra $5 a month on a lease, rather than a jarring $300 upcharge at the register, the consumer routinely upgrades.
That makes total sense.
It keeps the Apple ecosystem impenetrable while extracting maximum lifetime value from a user who might be feeling a pinch in their broader finances.
So Apple is trying to lock down the real estate in your pocket.
Yes.
But the battle for consumer tech revenue doesn't stop there. It extends to the most expensive consumer purchase next to a house, the driveway.
Oh, the auto turf war today was incredible.
Yeah, the war over autonomous vehicles took a massive turn today. Ford dropped a timeline that absolutely rattled the market, announcing a firm, aggressive plan to achieve true point-to-point autonomy by 2028.
And the reaction across the indices was violent.
I mean, Ford.
Right. You have Ford, a legacy company that has spent over a century mastering the incredibly difficult physics of bending metal at scale, planting a definitive flag in the ground for self-driving software.
And the market immediately recognized the threat, which is why Tesla is sitting at the very bottom of the market today as one of the top losers.
It completely undercuts their main narrative.
Yeah, because Tesla's entire valuation, which is just astronomical compared to traditional automakers, has always relied on the narrative that they would hold a monopoly on the robotaxi market.
Right. They've always been priced by investors as an untouchable software company that just happens to put wheels on its code.
But with a legacy giant like Ford committing to 2028, which is basically tomorrow in automotive development cycles, are investors finally waking up to the reality that building cars at scale is brutally hard, and autonomy is just going to be a standard feature, not a monopoly.
That is the exact repricing event playing out on trading floors today. The market is looking at Ford's timeline and realizing that the tech premium baked into Tesla's stock might be a hallucination.
A hallucination, wow.
And we'll think about it. If autonomy is ubiquitous by the end of the decade, then the profit margins on self-driving cars will collapse to standard automotive margins.
Because it just becomes a commodity at that point.
Exactly, it becomes a commodity. And it is vital to note the collateral damage here too, because Alphabet, the parent company of Google, is also getting heavily sold off today.
Wait, because of Waymo, Alphabet's autonomous driving division.
Precisely. Alphabet has poured untold billions into Waymo, expecting to dominate urban robotaxi networks.
Ah,
The market is now looking at the broader tech sector, looking at companies commanding these massive valuations and aggressively questioning if their competitive moats are actually an illusion.
yeah, when a 120-year-old manufacturing company can credibly threaten the most advanced software divisions in Silicon Valley, the era of the easy tech monopoly is officially over.
It's done.
So let's pull all these threads together. If you are listening to this deep dive and you're managing a portfolio today, you are looking at massive trading volumes. Like Microsoft and Meta are seeing heavy action as traders position themselves ahead of upcoming earnings.
Yep, huge volume there.
And the intense scrutiny on both of those companies comes right back to CapEx, capital expenditures.
Right, because investors are demanding transparency on these CapEx budgets now. We aren't talking about money spent on, marketing or office space.
We're talking about $50 to $100 billion being sunk into physical data centers and NVDA chips.
Exactly. And the trading volume today reflects deep anxiety. Investors want proof that Microsoft and Meta have a realistic timeline for when these physical assets will actually generate profitable software revenue, rather than just incinerating cash in an endless arms race for processing power.
So, synthesizing everything we've pulled from the indices, the central banks, and the tech sector, it seems like there are three distinct themes driving your money today.
I would say so, yes.
What's the first one?
The first theme is the global macro tightrope. We are watching central banks operate in drastically different realities. Singapore is tightening to fight inflation, while the U.S. Federal Reserve is staring at a cooling labor market and dropping wholesale prices.
And this divergence creates massive friction in global capital flows.
Exactly.
Okay, the second theme.
The collapse of the tech monopoly. Competition has reached a boiling point. NVIDIA is building CPUs to defend its territory. Ford is threatening Tesla and Alphabet in the driveway. And Apple is completely overhauling its financial model just to keep consumers engaged.
No tech titan is safe from encroachment.
None of them.
And the third theme that ties it all together.
The death of the hype trade. The market is aggressively scrutinizing valuations today. Companies can no longer sell a futuristic narrative and expect their stock to soar.
People want to see the real numbers now.
Right. Investors are demanding to see the math on profitability, and any hint that a company's competitive advantage is shrinking results in immediate, severe sell-offs, exactly like we saw with Tesla today.
It really leaves us with a critical structural question for the future of the market.
Yeah, and it's something every investor needs to be thinking about.
What's that?
Well, we have Microsoft, Meta, and Alphabet pouring hundreds of billions of dollars into the physical infrastructure required to build an AI-driven future, right?
Right.
But the macro data clearly shows that the ultimate end user, the U.S. consumer, is facing a cooling economy, rising unemployment, and tighter budgets.
Yeah, 4.2% unemployment.
So what happens to the entire stock market if the staggering, relentless cost of building the AI future fundamentally outpaces the everyday consumer's financial ability to actually pay for its applications?
That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.